Ponzi or genius? The digital asset treasury boom is crashing hard. Dozens of copycats that tried to mimic MicroStrategy's Bitcoin playbook are now unraveling, some with share prices down more than 90%. Nearly a quarter of DAT firms now trade below their Bitcoin net asset value, MNAV, meaning their market caps are worth less than the BTC they hold. Although MicroStrategy's stock has pulled back from its July peak, it continues to trade at a premium to its Bitcoin holdings. With 70 billion plus in Bitcoin and a 26 times gain since August 2020, it has been the single best performing stock in the US, even surpassing giants like Nvidia. In the next few minutes, I'll break down what MSTR is, how its financing flywheel works, why investors are still willing to pay that premium, and the key risk that could break it, not financial advice. I'll explain why I'm bullish on MSTR at the end. So what exactly is MicroStrategy? Founded in 1989, MicroStrategy began as an enterprise software company focused on business intelligence. It went public in 1998 at $12 a share during the internet boom. At the peak of the dot-com bubble, the stock briefly soared above $3,000. But in March 2000, disaster struck. The SEC forced the company to restate 2 years of results after it had booked revenue too aggressively, front-loading multi-year contracts. The correction wiped out reported profits, turned them into losses, and the stock collapsed more than 99%, from over $3,000 to under $30 within months. Michael Saylor lost nearly his entire paper fortune. Still, he never stepped down. MicroStrategy downsized heavily, rebuilt, and returned to profitability by 2003. For the next 2 decades, it entered a long, languish period as a steady but unremarkable software vendor. Then came 2020. Instead of parking cash in dollars or bonds, Saylor made a bold pivot, deploying $250 million to buy 21,454 Bitcoin at about $11,650 each. That single move transformed MicroStrategy into what many now call the world's first Bitcoin treasury company. Its strategy is simple: buy and hold Bitcoin, finance it cheaply, and let BTC's growth compound for shareholders. As the asset base grows, MSTR can raise even more capital at low cost. Saylor calls this a capital flywheel. As long as Bitcoin rises faster than the company's financing costs, the extra value accrues directly to shareholders. MSTR is often understood as a leveraged Bitcoin play, since its share price typically moves 2 to 3 times more than BTC itself. But Saylor's ambition is bigger. He wants MicroStrategy to evolve into a Bitcoin finance company, issuing Bitcoin-backed credit products and eventually positioning itself as a kind of Bitcoin bank. To see how Saylor is translating this vision into reality, we need to look at the evolution of MicroStrategy's financing playbook. To finance its Bitcoin purchase, MicroStrategy started with issuing convertible bonds between 2020 and 2024. These were incredibly cheap, with effective yields of just 0.2% to 2.6%. The trade-off: they could convert into equity at preset prices. Investors didn't buy them for yield. They bought them for the chance to ride MSTR's upside alongside Bitcoin. Take the 2025 convertible notes. Fully redeemed in July 2024, they had a conversion price of $39.80 versus a market price of roughly $150 at redemption. It resulted in 16.3 million new shares, about 10% dilution relative to the total outstanding shares. The $650 million raised from the convertible notes was deployed into Bitcoin that appreciated roughly 5 times over the same period. The gain per diluted share far outweighed the dilution. That's the capital flywheel working, creating accretive value for shareholders. Still, convertibles have their drawbacks. They remain debt instruments, meaning they must eventually be repaid, converted, or refinanced. And because Bitcoin is highly volatile, historically seeing peak-to-trough drawdowns of approximately 80%, there's always a risk if a maturity date lands in the middle of a deep bear market. Although all of MSTR's outstanding convertibles are unsecured and carry no margin call risk that would force the company to liquidate its Bitcoin, insolvency risk still exists if Bitcoin enters a prolonged downturn and financing windows close at the same time. This risk is what makes debt a constraint on flexibility and resilience in MSTR's capital structure, so it announced in its latest Q2 earnings that it plans to equitize all its outstanding convertible debts by 2028. The company also did once issue $500 million of secured notes backed by Bitcoin in 2021 and took out a secured term loan from Silvergate Bank in March 2022. Both facilities were fully repaid, removing any collateral risk to its Bitcoin holdings. Beyond debt, MicroStrategy has also tapped equity markets through at-the-market offerings, selling newly issued shares directly into the open market at prevailing prices. Unlike debt, equity carries no repayment obligation, making it a more flexible source of capital. The trade-off is dilution for existing shareholders. But if the stock is trading at a premium valuation, ATM issuance can be one of the most cost-effective ways to raise funds. To address dilution concerns, management introduced a safeguard in its latest Q2 earnings release. No equity will be issued below 2.5 times market NAV to acquire Bitcoin. However, on August 18th, the company added a third carve-out. It may tactically issue shares below 2.5 times MNAV when otherwise deemed advantageous to the company. This addition introduces flexibility, but also gives management broad discretion, which risks making the rule redundant. The intention is good. We'll see how it holds up in turbulent times. Since 2024, MicroStrategy has also experimented with a new financing tool, perpetual preferred equity. These instruments are a hybrid between debt and equity. Like equity, they are perpetual. There's no repayment date, and they don't convert into common stock. But like debt, they carry fixed payments and sit above common equity in the capital structure, meaning preferred holders get paid before common shareholders in a liquidation. Instead of paying interest like traditional debt, preferreds pay dividends. For MicroStrategy's preferred issuances, these dividends range from 8 to 10%. 3 of the 4 series are cumulative, meaning if a payment is skipped, the obligation doesn't go away. It accrues, can step up to as high as 18%, and must eventually be settled. The remaining series is non-cumulative, so any missed dividends are permanently forgiven, giving the company more flexibility. Preferreds give MSTR a way to raise large amounts of capital without more debt or massive dilution. The trade-off is ongoing dividend obligations, over $600 million a year across interest and preferred payouts. This is also where the Ponzi accusations come in. Since Bitcoin itself doesn't generate cash flow, MSTR needs to continuously raise fresh financing to cover these obligations. But here's the key distinction. Unlike a true Ponzi, MicroStrategy's liabilities are backed by real Bitcoin assets, not empty promises or fraudulent accounts. To ensure that new investors are not merely paying the bill for existing ones, it's critical to assess the ongoing solvency risk of MSTR and stress test its ability to service those obligations under worst-case conditions. Let's look at the downside case. The biggest risk to MSTR is if Bitcoin crashes and capital markets seize up, leaving the company unable to meet its interest and dividend obligations. While all of its debt is unsecured and therefore carries no margin call risk, a suspension of dividend payments due to an inability to raise capital would trigger panic. The stock price could tumble, and Bitcoin itself might decline on fears that MSTR would be forced to dump holdings. That could set off a downward spiral. This is why the ability to cover ongoing interest and dividend payments remains the core risk to MSTR's capital flywheel. As of September 2025, MicroStrategy holds close to 640,000 BTC. At roughly $110,000 per coin, that equates to a Bitcoin NAV of about $75 billion. But if Bitcoin were to suffer a greater than 80% drawdown, not unprecedented, and NAV shrinks to just $15 billion. Against that, MSTR's annual interest and dividend obligations total about $614 million. Even under an extreme drawdown scenario, and assuming no additional BTC purchases, asset coverage would still exceed 20 times. Until the company fully equitizes its convertibles, these bonds remain a long-term liability that must be considered in the worst case. The key risk is if a convertible matures while MSTR's share price is below the conversion price. The earliest maturity is March 2028, a little over 2 years away. Even in a worst-case scenario where NAV shrinks to $15 billion, there should still be enough cushion to refinance or repay the $1 billion coming due. More likely, the company will equitize this debt before maturity. Of course, assets and liabilities are moving targets, so we must continue monitoring how they shift over time. But based on the information available today, MSTR appears solid enough to withstand an 80% Bitcoin drawdown. Here is a snapshot from MSTR's Q2 earnings webinar recording.
I think that our structure is smooth, and we wouldn't miss a single dividend payment on an 80% drawdown. On a 90% to 95% drawdown, in theory, you might suspend something for a little bit of time, but you would eventually get back current on it. So, so I think in terms of robustness, it's pretty robust. And if you compare it to the fragility of a conventional bank, think about the leverage we've got in order to generate our earnings. We've got maybe 1.2 leverage. A typical bank's got 10, 20x leverage to get their earnings.
There are some interesting Q&A questions. and I'll include the link to the full recording in the show notes. Now that we've examined the downside risks, let's turn to one of the most debated questions around MicroStrategy. Why does it trade at a premium to its Bitcoin NAV? As of September 2025, MSTR is trading at around a 1.5 times MNAV multiple. So why does this premium exist? Let's look at what MSTR says. Credit amplification. Unlike spot Bitcoin or ETF, MSTR layers in financing tools like convertibles, preferreds, and equity issuance. This intelligent leverage can turn $1 of capital into $2 to $4 of effective Bitcoin exposure. Options advantage. MSTR has one of the deepest derivatives markets of any stock, with over $100 billion in open interest. This provides far more trading and hedging flexibility than spot Bitcoin, which has about $20 billion in CME futures, or even ETFs, which have around $30 billion in options. Passive flows, because it's included in the NASDAQ 100, MSCI, and Russell 1000, MSTR benefits from steady passive index inflows. While it hasn't yet been added to the S&P 500 despite recent anticipation, it remains a realistic goal for the near future. Institutional access. MSTR sits inside the $35 trillion equity and $60 trillion credit markets. While institutions can now access Bitcoin through ETFs, many remain constrained by mandate or risk profile. MSTR offers a compliant, liquid gateway with deeper financing and derivative options, and by issuing products across the risk-return curve, it taps pools of capital ETFs alone cannot reach. Another way to understand this premium is to look at the valuation framework that MSTR laid out for valuing Bitcoin Treasury company. This framework follows the same logic used to value traditional companies. You start with earnings and apply a multiple based on factors like growth, margins, competitive position, and execution track record. For a Bitcoin treasury like MSTR, however, the starting point isn't earnings, but Bitcoin NAV, the value of all the Bitcoin on its balance sheet. To that, you add the Bitcoin gains MSTR generates through its financing flywheel, essentially the extra Bitcoin it accumulates without diluting shareholders. Then, just like with traditional companies, you apply a multiple. That multiple depends on factors such as the sustainability of BTC gains, scale and liquidity, access to capital markets and credit products, balance sheet strength and credit quality, and the company's long-term vision and track record of execution. So the premium investors are paying isn't just for Bitcoin itself, it's for MSTR's ability to continuously raise capital, amplify exposure, and add more Bitcoin per share over time. There is broad agreement among analysts covering MSTR that it should trade above 1 times NAV due to the factors listed above, even if the exact multiple varies. Often, market perception is shaped less by fundamentals than by narrative and storytelling. By now, you've probably already formed your opinion of MSTR, but I want to wrap up by sharing mine. I am bullish on MSTR for a few reasons. A more resilient capital structure. MSTR has steadily strengthened its balance sheet, equitizing past convertibles and successfully launching its perpetual preferreds. Its latest STRC offering was 5 times oversubscribed, showing strong product market fit. The company has also set clear rules on when it will issue new equity. This discipline reduces dilution risk and makes the company more robust through cycles. Its assets versus annual dividend and interest obligations can withstand even an 80% drawdown. While a deeper drawdown isn't impossible, the probability is relatively small. A defensible head start with institutional access. As the world's largest Bitcoin treasury, it took MSTR 5 years to build its position with little real competition. That head start not only makes it nearly impossible for new entrants to replicate its scale, but also gives MSTR cheaper and deeper access to capital markets. Its proven track record, managing Bitcoin through multiple drawdowns, has earned it credibility with traditional institutions. Conservative leverage with room to grow. At 20 to 30% leverage, there is still room to expand as Bitcoin matures and volatility declines. Over time, regulatory clarity should improve and institutional allocations should grow. That opens the door for more financial products to be built on top of its Bitcoin balance sheet. Because of this, I think it's too simplistic to view MSTR as just a leveraged Bitcoin trade. If managed properly, it can tap into the $90 trillion institutional capital pool that Bitcoin, in its commodity form, cannot. That said, the key debate is always about the MNAV multiple. What's fair value? 1.2, 1.6, or 2 times? There's no perfect answer. It's more art than science. What matters most is that the company remains disciplined, transparent, and prudent in ensuring each round of financing is accretive to shareholders. So yes, MSTR is risky, But in my view, it's also one of the most compelling ways to gain Bitcoin exposure if you believe in the long-term thesis of BTC. For transparency, I don't currently hold MSTR stock, but I'll be watching for the right opportunity to add exposure. The world is changing fast, with 10 times and even 100 times opportunities emerging every day. Let's stay curious, keep learning, and if there's any topic or company you'd like me to cover, let me know in the comments. Thanks for watching, and see you next time.